From a top-down perspective, the pickings are pretty thin in the coming week, with interest rate decisions from the Bank of Canada and the European Central Bank likely to be the main features. Those announcements are due on Wednesday the 9th and Thursday the 10th of September. By way of a reminder, the Bank of Canada's target overnight rate stands at 0.25%, while quantitative easing is running at 5 billion Canadian dollars a week, the equivalent of $200 billion a year. The ECB's main refinancing rate stands at 0, while its latest round of QE, known at this time as the Pandemic Emergency Purchase Programme or PEP, well, that's been set at €1.35 trillion and is due to run until June 2021. Some may say that Governor Tiff Macklem in Ottawa and President Christine Lagarde in Frankfurt therefore don't have a lot of room for manoeuvre should they need it, although they may disagree. Some central bankers continue to talk about more QE and even negative interest rates, while pressing at the same time for more fiscal stimulus and government spending. Let's see what the monetary authorities have to say this time around, but it doesn't feel as if rates are going to go up in any great hurry, especially as the US Federal Reserve is now leading the debate when it comes to inflation averaging and letting inflation overshoot its 2% target, at least for a while. On the corporate front, a good selection of FTSE 100, FTSE 250 and small cap stocks are due to update their shareholders in one way, shape or form. Names which may be of particular interest for what they say about themselves, their industry or the wider economy include Dechra Pharmaceuticals on Monday the 7th of September, equipment hire giant Ashtead, retailer JD Sports, Travis Perkins, Meggitt, house builder Vistry, estate agent Beaver Lettings and Fever Tree Drinks all on the 8th, computer centre in Biffert on the 9th, retailer Dixon's Carphone and brickmaker Forterra on the 10th, before estate agent Winkworth and fund manager Ashmore round the week off on Friday the 11th of September. However, the company which just might cause the biggest fuss in the week ahead is grocer Morrisons. It's due to release its first half results on Thursday the 10th of September. The Bradford headquartered firm's shares have done relatively well over the past year, rising by nearly 5% compared to a fall of more than a quarter in the FTSE 100 over the same time span. There are probably three factors at work here. First, the company's full year results from in March showed a fourth straight increase in pre-tax profit and a fourth straight increase in the ordinary full year dividend. Second, Morrisons provided a vital service by helping keep the nation fed and watered during lockdown when its goods and services were very much in demand. And finally, maybe, just maybe, the grocer started to keep the discounters such as Aldi and Lidl at bay. The latest data from consultants Kantar World Panel showed that Morrisons' market share rose by 0.1 of a percentage point to 10.2% in the 12 months to August. All of that means analysts and investors will look to three key sets of figures when the first half results are released. The first is like-for-like sales for the second quarter and indeed the half. Morrisons' run of 14 consecutive quarters of like-for-like sales growth, excluding fuel and VAT, came to an end last year, but a run of 3 straight declines also stopped in the first quarter of this year as lockdown hit, customers stocked up, and sales rose 5.7% year on year. It'll be interesting to see how the second quarter to the end of July compares. The second figure to note is pre-tax profit. For the full year, analysts are looking for an 8% increase to £440 million on an underlying basis. Yes, sales have been rising, but so have costs, thanks to COVID-19, and Morrisons accepted no furlough cash and has instead paid bonuses to hard-working staff. Chief Executive David Potts has estimated that the increase in COVID-related costs will broadly offset the benefit of the holiday on business rates, where Morrisons estimates it will get relief worth £228 million this year before payments recommence in April 2022. In the first half of last year, underlying pre-tax profits reached £198 million. Finally, the dividend. Morrisons paid out 8.77 a share last year, including 2p in special payments. However, a decision on a second special last year was deferred owing to the uncertainties created by the pandemic, which hit demand for fuel and therefore a ready source of cash flow for the company. For the whole of this current year, analysts are looking for an 8% increase in the ordinary distribution to 7.32 a share. So again, that looks like a fair test for the first half payment, which came to 1.93p a year ago, albeit with the 2p a share special on top. Besides those headlines, watch out for progress in the relationships with Ocado, Deliveroo and also Amazon Prime, as well as the operational targets that Chief Executive David Potts laid out alongside March's full year results. The three main thrusts there were a drive towards £1 billion in annual sales from wholesale via an expansion of the supply deal with McCall's, further progress towards the target of £75 to £125 million of incremental profit from wholesale services online, up from £68 million last year, and 5 new store openings plus the ongoing Fresh Look store refurbishment programme. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.